Very good evening to all of those out there in the dark. This Thursday, the 3rd of July, 2025. Half a year has gone. And as I just said to Pascal at Rand Swiss, who kindly sponsor this event for me every quarter, where the hell has this year gone to? I'm either getting old very quickly and I'm knocking on the door of my coffin, or perhaps the world is just racing ahead because President Trump is making the world seem like a faster place. But here we are sitting down literally 6 months since the start of the year and looking at the basic metrics that I run through. The Aussie year to date is up 14.9%. The small cap index is down 0.9%. The mid cap is up 9.7%. All the action this year, as we all know, as market followers, has been in the resources. The Resi is up 49.2%, driven by gold, which year to date, sitting currently at $3,327.67 as I speak to you, is up 27.2%. And even dear old Bitcoin is knocking on the door of an all-time record high at $109,246 $109,246 as I speak. I'm having a zoomer moment, and that's up 15.6% year to date. So we've had a very interesting year. Given that last year was a year where the small cap index was up over 50%, this year the action has been completely in areas of the economy and the market which perhaps many would not have believed would have been the case going into Q4 2024. But as I said at the start of this year, not that I'm an economist, not that I follow global geopolitical trends extremely closely, and I'm certainly not a macro guy, but with the advent of Mr. Trump coming back in for a second term and the Moses tablet of tariffs and the constant change in the policy order in the United States, and as we speak, the big, beautiful bill, as he calls it, is currently working its way through the House. That's having a profound impact on global stock markets. And the US market, as I'm sure we all know, is again at record levels. I saw on my social media page as I came into this presentation that one of my followers had tracked the South African market in US dollars. And on an emerging market basis, it was the best performing stock market anywhere in the world year to date, which again is quite surprising if you looked at where we were last year and the prospects for the GNU, all the political infighting and all the corruption, malfeasance, and the lack of economic growth we all bemoan on a daily basis. I'm going to be sipping my water here. If I'm looking this way, it's because my dog is sitting on the chair just over there looking at me, probably wondering who I'm talking to. He might come and join me in a short while. I've got my water to sip on because anyone trying to do a 1-hour webinar, speaking as I do live off the cuff, with very few unprepared notes, you get a little bit hoarse. So if I stop to take a sip of water, my apologies. I said to Pascal before I came on, what I intend to do in this specific presentation is to quickly rattle my way through the top stocks of 2025, move on to some new ideas, which perhaps would interest you more than the performance year to date or lack of performance year to date in my top stocks, and then open up the chat box for Q&A, because I'm led to believe that the Q&A session of these presentations tend to be very popular. So for those out there who have got questions they are burning to ask, please pop them in the chat box and I will endeavor to collate them and answer the ones where I feel I can actually give you a reasonable answer. So the chat box is open. For interest, I was in Johannesburg a couple of weeks ago attending the 3-day site visit of ASP Isotopes, which is the NASDAQ listed small cap, which is endeavoring to buy out Renogen. So if there's any questions regarding that transaction, I'm happy to answer where I can. The vote on the deal is happening in the next few weeks, and all being equal, from what the circular says, the delisting of Renogen and the secondary listing of ASP onto the Johannesburg Stock Exchange should happen sometime in mid to late August. I've also just come through the tail end of reporting season. Um, as I came on air, I see the Hudeko results are out, which I'll briefly touch on. I also had an engaging conversation with Stephen Joffe, the CEO of Invicta Holdings, on Monday and Tuesday this week, and that will be one of our new ideas, and some other bits and pieces which perhaps may interest you. So again, as I sip my water, year to date, my top stocks is down 2.19%. It started the year off performing above the market, but as the interest in the Aussie and the Resi caught the market's attention, the interest, particularly in small caps, given the tight liquidity and the domestic focus of their earnings, was pushed on the back burner. And even the better quality mid caps have struggled to gain some traction because all the market's attention, as we know, has been in the heavyweight Aussie stocks like Naspers and Process, alongside the gold shares. So why would you want to get involved in the small to mid cap sector? Well, quite frankly, owning a small basket of the Aussie has more than given you a sufficient return for your portfolios year to date if you are an institutional investor. And again, just a caveat, I am an institutional analyst. My prime client base are the major institutions in this country, although I do have affiliations with a couple of private client stockbrokers, of which I'm very honored and proud to be engaged with Rand Swiss to do their quarterly presentations. So as it stands right now, I'm currently updating my research note for publication tomorrow to my clients on the performance of the top 10 year to date for the end of June. To get my magnifying glass out is because I'm getting old and grey and I print out in small prints. So as it stands year to date, my top 10 is down 2.19%, which is a significantly better performance because at the end of April, it was down 10%. At the end of May, it was down 3%. So it's clawing itself back quite nicely. So as it stands right now, I'm going to run through the top 10 and the performance. Avatec year to date, including dividends, is up 1.65%. Cash build is my worst performer. It's down 25.85%. Combined Motor Holdings keeps vacillating between being in profit and being slightly in the red. It is down 3.12%. Grindrod, which was heavily down at one stage and then had a remarkable recovery, but latterly has come off a boil with the fact that the CEO, Kalani, is stepping down to join Kumba as their chief financial officer. That stock is currently up 7.12%. It has been sharply higher. Hoskins Consolidated Investments is now down year to date 20.45%, as some of its assets in the gaming sector has come under severe strain because of the growth of online gaming eating into its lunch, and the fact that the oil sector, where it has significant investments in the Venus field off the coast of Namibia, has come under a bit of sentiment pressure because the oil price under President Trump has fallen quite sharply, although the recent Iran-Iraq mini-warette has plumped up the oil price again, but it's still down 20% year to date. KAL Group, the old Carp Agri, at one point was down about 20 to 25%. That's also staged a recovery. We're now down 13.2% year to date, and I expect that to continue its recovery into the second half on reasonable earnings prospects. The best performing stock year to date is Nampak. It recently hit a new 52-week and all-time high at 25.8% up year to date. We then got PPC, which again year to date was heavily down up until sort of March, April. It staged a staggering rally recovery and it's now up 7.8% and recently hit a new 52-week high. We've got Rainbow Chickens again, which was down quite heavily. We're now up 5.4%. And then lastly, Rhodes Foods Group, RFG, which has been holding its own for much of this year, but recently issued quite a sort of lackluster and I would call fairly pessimistic trading update for its first half. And they are now down uh, just 10%. So a mixed bag. We've got like 5 stocks up and 5 stocks down. So I'm just going to run through a couple of the ones which have not fared me well as I sip my water. Again, I'm going to ask you to put those questions in the chat box. Not that I even know where the chat box is, but I'm sure I'll find it in due course. Or maybe there's no questions, but I'm sure there are. Cash built. When I did the selection in December 2024, the economic landscape in this country, as many of us would know, were a little bit different from where they are right now. There was a general expectation that the GNU would foster faster economic growth. There was expectation that the interest rate scenario would probably fall faster than has actually occurred. And I think the general optimism regarding the GNU bolstered the general expectation regarding the economy, none of which have panned out. We all know that the GNU, particularly the ANC and the DA, are fighting like old fishwives. Yes, we're leaving you. No, we're not. We're leaving you. Well, no, we're not. We're going to leave you. Well, actually, not. We're not going to. So they're all just infighting. But that hasn't had a significant impact on the economy because the Rand is now at 17.49, which is 6.93% stronger year to date. And the stock market's hitting near record highs. So clearly the market is looking past the fighting amongst the political children at the bigger picture and the valuation of this emerging market, perhaps compared to others. Cash built back in December was hitting a reasonable click. It was trading at about 225 to 250 Rand at one stage, and I really thought it was going to move higher. The same was true with Italtile. But as we moved into 2025 and all the political infighting, the economic issues, the lack of employment growth, the fact that the two-pot system had basically, been spent and hadn't really gone into the DIY and residential market, cash built basically quickly unwound. And despite the fact that year to date, the quarterly performance has shown fair to okay growth, up 5 or 6% in terms of revenue and sales, it's still not enough to excite the market. And cash built and Italtile, as the leading proponents in the residential refurbishment and DIY market in this country, have had a pretty torturous year. So cash built, having knocked on the doors of about, recently about 135 to 140 Rand, hit 154 Rand as of the end of June. So I've clawed back some of my significant losses. So we'll wait and see what happens for the second half. But I certainly don't believe it's going to claw back a significant proportion of our 25% loss that this portfolio has suffered year to date, which is dragging down the overall performance. So that has been my worst performer year to date. It's amazing how you can look back on your selection in December when the economic and corporate fundamentals were significantly different. And then 6 months later say, I wish I'd never chosen it. But it's cast in stone and I can't change my mind. The second worst performer has been Hoskins Consolidated Investments, chosen again last year because the underlying discount to net asset value and the prospects of the oil sector last year, when the oil price was trading in the mid $80 a barrel level, meant that HCI in my book looked like a reasonable prospect. But as we all have seen in the last few months, the unwind of Soho Sun, its one-time large asset, as the online gaming sector has basically eaten the lunch of the bricks and mortar casinos, has been quite evident. And as I wrote in my commentary out tomorrow, Johnny come lately, to excuse the pun for Johnny Copeland, they're only now beginning to address the threat of online gaming to the bricks and mortar casinos. But the trouble is the share price of Soho has fallen very, very sharply. And even though the share price of Southern Sun, the hotelier group, has risen quite sharply, and other assets inside HCI have held their own, a combination of the weak oil price, A changing sentiment regarding oil assets and the online gaming situation has certainly smacked HCI as it stands right now at 100 and roughly 127, 128 rand. It's trading at about a 54 to 55% discount to the net asset value. Results to the end of March came out with a net asset value from memory of about 331 rand. So basically, the entire listed portfolio of HCI is trading at a discount, and you get all the oil assets, the platinum assets, the coal assets, the property assets, and all the other bits and pieces in for less than nothing, which in the long run, I'm sure, will start to pay reasonable dividends. But investors are looking at the here and now, not what may transpire out in 5 or 7 years when the dividends from the oil assets start to flow. So I'm an HCI shareholder. I continue to believe that in the long run, I will make very good money. I was at a substantially lower level when I broke the story of the oil discovery in February 2022, when HCI was trading at about 80 rand and it got to a high of around 230. So since then, it's more than halved. But Johnny Copeland, the CEO, is an enigmatic figure. He very rarely, if ever, gives interviews. He's not exactly friendly towards the market. And even when results come out, he does not engage. The only real way to engage with HCI is to go to their annual general meeting in Sea Point once a year, sit in their boardroom and listen to the oracle speak and try and get some clues as to where this company is going. Because as I've said on many occasions, Johnny Copeland doesn't give a damn about shareholders. He never has and he never will. He's focused on his underlying union shareholders, his own shareholding, and those of his cabal around HCI, and everybody else just hangs on for the ride. But I would have to assume that given that he's a material shareholder in some of the underlying assets, he does not want his underlying portfolio to be impinged too heavily by sentiment issues. So HCI to me is a huge value play. Moving on to some of the winners. Nampak is a stock that may be familiar to the audience. I chose the company back in 2023 as one of my wild cards at approximately 201 rand and 18 cents equivalent after the consolidation and the rights issue, with a target price of 450 rand. And everybody thought that I was smoking my socks. And as it stands today, Nampak is at 523 rand, having been nearly at 550 in the last couple of weeks. I chose the stock again this year as my wild card with a target of 650. And that selection was done at 406 rand 54. And again, I was wildly derided for a very aggressive price target. But it quickly moved from 406 to 550 in a matter of months. And with Phil Roux, the erstwhile CEO, announcing his departure at the end of September, and I hosted the results luncheon in Cape Town for institutions, literally a matter of 6 to 8 weeks ago. The CEO was in extremely upbeat form regarding the prospects for Nampak, with 95% of the heavy lifting having been undertaken, with further asset sales from Zimbabwe and other non-core assets yet to come, with a balance sheet being in materially better position than it was 3 years ago when he became the CEO and activists became involved. And that when Andrew Hood takes over as CEO, he's an operations guy, and there's significant margin expansion and an uplift in the underlying profitability, which is still not fully evident in the Nampak business, which I think will be the main thrust of this company's earnings growth in the next couple of years. I also believe that dividends are going to be on the cards. They could have easily have paid a dividend this year, but I think the underlying activists and board decided to continue to pay down debt. And it would not surprise me if in 2026 a dividend starts to be paid, showing you that the unwind of the debt in the company and the significant improvement in cash generation and the prospects engender confidence that the board can continue to pay or should be able to pay a reasonable dividend. So Nampak to me at the current price of 523 rand, I think we'll get eventually to my 650 Rand target. So hopefully I will prove my naysayers wrong. Another stock which has done remarkably well year to date, I'll touch on two, is Grindrod and PPC. Both stocks have had a very volatile year. Grindrod at one point was trading down at about 11 Rand. You may recall that last year, that following the political violence in Mozambique and the closure of the borders between South Africa and Mozambique, Grindrod has extensive operations moving goods from this country, particularly from the mines, into its port of Maputo operations. And with the closure of the border, there was an impact to the volumes going through that operation. And that had a sentiment impact to the company's share price. And of course, it also translated into slightly weaker earnings, which we recently saw in the trading update. Saying that, when the stock was trading at 11 Rand, the prospects for the third-party rail, the PPPs, which the Transport Minister Barbara Creecy has been pushing through at a rapid pace of steam, to use an analogy, including a very interesting piece in the Business Day today regarding her determination to get third-party rail up and running as quickly as possible, has indicated to the market that Grindrod, as one of the only companies in this country with expertise in running locomotives, which actually has locomotives in its rolling stock, and has the ability to partner with companies to move product from mine, field, factory to port, is extremely well placed going forward when the third-party rail starts to gather full steam and traction, which is probably only going to be in 2026, 2027. So the share price moved up, I think, from memory recently to about 13 Rand 50, 13 Rand 60. And then the well-regarded CEO, Kalani Mbambo, decided to step down only after 2 or 3 years of a job. And that led to some concerns given his expertise in logistics and specifically in rail. And then it eventually transpired he's becoming the chief financial officer of Kumba, which is a major step up for the gentleman from going from a small cap to what is a vast mining enterprise. Now, what is very interesting is, to me, I was not that surprised that he was going to someone like Kumba, because Kumba and the Iron Ore Association are very keen to take over the Session to Saldanha iron ore export line, because it has been so badly managed by Transnet. And having someone with expertise in rail and logistics as the chief financial officer of Kumba clearly makes sense if the Iron Ore Association, with Kumba as one of their lead members, decides in due course to actually buy or operate that line themselves. Who knows, maybe with Grindrod, it's a possibility, who knows? So whilst his departure will be sorely missed, he leaves at the end of the year and the market is awaiting the replacement. There is tittle-tattle that a gentleman who currently runs the bulk terminals may take over, but we will have to wait and see who eventually takes over from Kalani. So Grindrod is off its best, but certainly the prospects in that business remain very robust. And then PPC was riding high at the start of this year. But on the 21st of January, Matthias Cabdarelli, the CEO, announced a 3 billion Rand expansion of a new purpose-built cement plant here in the Western Cape in Riebeek, where PPC already has two old operations, but they are between 40 and 60 years old. One is in De Hoek, near Piketberg, and the other one is in Riebeek, about 40 kilometers away, where the lime deposit is situated. So what they intend to do is to close those old operations and build one of the lowest cost, most efficient cement plants in the country, producing about 1.6 million tons of cement a year into the province, which has the fastest growth currently in this country, which is the dear old Western Cape. So one can't fault the strategic rationale of wanting to be the lowest cost producer in the fastest growing economic province. But the market took fright at the substantial capex of the company, and the share price was rapidly unwound. And at one point, it was down about 20 to 25%. Then in late April at the PPC Capital Markets Day, which I participated in, and the site visit to the Riebeck operations, it was articulated exactly why they're doing this and what the payback period would be. To which the CEO said, if we did not invest in this plant, the Chinese who are operating in this country and in Southern Africa would basically eat the cement market's lunch in this country. So PPC, in order to remain relevant and cost competitive, had to invest to try and secure its future. And he seemed to indicate that of the numerous cement companies operating in this country, there are only 3 potentially would be around in 5 years' time. And PPC, he said, will be one of them. So that engendered a shot of confidence in the share price, and it moved up very sharply at the end of April. And then in the last few weeks, on the back of very good results and dividend, and the fact that management reiterated that the underlying balance sheet exposure of the company is extremely comfortable towards the capex that they're expending for the Riebeck plant, which should be finished by 2026. The share price had a hell of a run and hit a new 52-week high, I think about 545, 550. But year to date has come back a wee bit. It's now at 517. So when I chose PPC at the start of this year, my rationale was I was backing the jockey, not the horse. The CEO who comes in from Intercement, one of the world's leading cement companies, has a proven track record over 30 years of turning companies around and making them efficient and highly profitable. And was exactly what PPC needed a year and a half ago after the previous CEO basically stopped the company going bankrupt by selling off assets and renegotiating the company's vast debts with a bank to stabilize the ship. So when the ship stabilized, they had to get an operator in to start turning the company around, improving the operations and making money, which is exactly what Matthias Caldarelli is now doing, and what is being clearly seen in the earnings and the share price. I'm looking down because my dog, come on, you want to come up? Come on. He wants to come up and sit behind my chair. There he is. He's there. He likes to keep warm behind my back. So apologies, but in my life, the dog comes first. Other touch points I want to give. I mentioned that Carp Agri, or KAL Group, year to date is down 13.2%. It is currently trading at roughly 42 Rand. Now, interestingly, it's moved up about 10 to 12% in the last few weeks from its recent lows. There was a concern that its underlying business was not faring that well. But following its interim results and a charm offensive by management and a very detailed feedback session, it is very clear to those of us that have followed Carp Agri or KAL Group for a number of years, and I've followed the company now for nigh on 20 years, that after 12 months of very lackluster, if not, I want to say, weak earnings, the company has regained its footing. And it is an expectation that earnings growth this year will be around 8 to 10%, to take the company's headline earnings per share up to roughly 6 Rand 30 to 6 Rand 50. Now, on that sort of level, if it does transpire, and I'm led to believe from my engagement with the company a few weeks ago that they're well on track to hopefully meet that market guidance. But with the share price trading at 38 Rand, the price earnings ratio of around 6 meant that this retailer was looking incredibly cheap. But perhaps it's cheap for a reason. Only 27% of KAL Group's trading profit comes from what is classed as core agriculture. So it's significantly diversified over the years, moving into fuel, convenience stores, and quick service restaurants. But as I wrote in a note a few weeks ago, and in my notes in the Financial Mail, the big Achilles heel inside KAL Group is nobody really knows what the company is. Is it a retailer or is it an agricultural business? Well, agriculture, as I've said, is 27% of trading profit. So it isn't really uh, an agricultural company, but it can't be classed as a pure retailer because the tail continues to a certain regard to wag the dog. And it's been agriculture which has been keeping the business on the straight and narrow for the best part of 12 months as the retailing side, particularly the fuel side, has been under the whip. So I think in due course, as the agricultural side gets down to less than 10% of underlying profit, that the pendulum regarding KAL Group will switch back towards, well, hang on, this is basically a retailing stock, which is growing reasonably nicely. So why is it on a 6 or a 7 PE when most of the retail sector is trading on significantly high levels, in the high teens, if not in the 20s? Now, I do not foresee KAL Group ever getting to the vaunted rating of the likes of a TFG or a Mr. Price or a ShopRite, etc., etc. But from my memory, having covered this stock for 20 years, back in the day when it was an OTC listed company, the price earnings ratio for KAL Group, or Carp Aggregates as it was then called, was in the early teens. It was an 11, 12, 13 stock, consistent performance of between 15 to 16% compound growth per annum in earnings. Very well regarded and strong balance sheet, which it still has, and a consistent dividend payer. It's only the speed wobble in earnings in the last couple of years which has somewhat derailed the market sentiment, and the share price has fallen from about 54 Rand down to a low recently of 38. But there has been some interesting nibbling in the stock by certain institutions in the marketplace who are slowly building positions. And if, as I believe, that the watershed moment will be the last set of results we have seen in KAL Group to September 2024 and to March 2025, and there is an incremental improvement in the year-end results to September 2025. But I think the stock at current levels will start to creep up. But I think it'll only start to creep up as the market sees that the company has turned the corner. So there's no immediate rush to go out and sell your grandmother's kidneys to buy KAL Group. But as I've been advocating in the work that I've been doing, I would certainly put KAL on a very, very close watch list because the stock only has 74 million shares in issue. It is reasonably tightly held. And if a tide does turn in this company and it starts to be seen as more of a retailer than an agricultural business, which will take time, that rating will start to re-rate very quickly. It certainly will not happen overnight, but I truly believe that in a couple of years, that KAL Group will be trending back towards my target level of 48 and then 54. So that's one of the stocks in this top 10 that I would be keeping a very close eye on. I'm looking at the time here. It's come up to 7:05. So enough of my top 10. I've mentioned the two dogs and the three best performing stocks, including one KAL Group, which I think has got prospects for a much better second half. I'm now going to move on as I quickly look to see if any Q&A has come in my little chatty box thing. Oh, there are. I have a wrong chat box open. That's why I couldn't see it. Okay. Okay, I'll put that to one side. I said to Pascal that new ideas are the lifeblood of an analyst, particularly work that I do in small to mid caps. I'm sitting in my home office here where I spend the majority of my day. Not that you can see the piles of files lying on the floor, but anyone who has followed me on social media on my @SmallTalkDaily page sees that I post regular pictures of my office and the mountains of paperwork on the floor and the files, excuse me, like this, which I have on a consistent basis, which I work on. And in many cases, I have dozens of ongoing files open at any one point in time because I cover about 60 companies. and some fall by the wayside, and some start to look interesting when certain elements quickly change. Now, in the small to mid cap universe, information is not generally forthcoming because most analysts do not cover the sector. I'm one of the very, very few that has a long-term track record in covering small to mid caps now for the best part of 30 years in the domestic marketplace. And as the brokers have basically given away their coverage of the sector, the amount of publicly available information to the likes of a private client has become less and less and less. And because of relationships that I have with many companies, some going back 20 or 30 years, and the fact that I've covered these stocks in many cases for just as long, and when you have the memory of an elephant, as I do, and lots of gray hair and a gray beard, information sticks. So when something resonates regarding a potential change in the landscape, it quickly puts the hairs on the back of my neck tingling. And one company, which to me is currently looking very, very interesting, is Invicta Holdings. Now, as a bit of a preamble, Invicta Holdings is a stock that I've now covered for the best part of 26 years. It is majority owned by the billionaire Christo Visa, who's the single largest shareholder. And if you add in family members, directors, and other interested parties, probably 60% of a company is owned by what I would call insiders. It is a small cap business valued at roughly 3 billion rand. Its main area of activity is supplying spare parts and widgets and bits and pieces to repair things. So if you've got a capital equipment machine like an excavator, where the tracks need replacing, or the bucket needs replacing, or a ball bearing, or a filter, or whatever, they provide that. And they have international operations, not just in this country, but throughout the world, and with a rapid expansion of their business into Europe and recently into the United States. They have a share, excuse me. They have a share in a Chinese manufacturing company called KMP, or Kian, where many of the products are made and are then supplied into the aftermarkets. So basically, they sell what you would call aftermarket spare parts. You know, if you're buying a brand new Volkswagen, when it's under warranty, you only want to get genuine Volkswagen parts. But once it comes out of warranty and you've got to pay for the parts yourself, you're going to look for what I would call a knockoff comparative part, which does the job just as good. Doesn't have a VW logo on it, but it's significantly cheaper. That's what Invicta does. It supplies many of the aftermarket parts for products that perhaps users are looking for a more affordable price point on. Now, the share price has been under the whip for quite a time. I had a buy in the stock just after COVID at 4.86 rand, and the share price quickly ran to 25 rand in about 2 to 3 years. But as the CEO, Stephen Joffe, likes to remind me, I called the stock as dull as ditch water 2 years ago, because if you check the Invicta share price chart, and I'd urge you all to pull up Google Finance and put the Invicta chart in, IVT, you'll see that a hell of a run after COVID, and then went sideways for 2 years at about 25 rand, stepped up a little bit, and for the last year and a half has gone sideways in the early 30s. Nothing to get excited about. So you're probably saying, Anthony, why would I get excited about a stock which has basically gone sideways for 3 years? And it goes back to what I like to look at is called sentiment change. We had earnings from a company which were out literally Monday, Tuesday this week. They showed a very nice growth in headline earnings per share, up 13% to 5.53 rand. The company is basically effectively debt-free. They've got a strong balance sheet. They pay good dividends, and they have the ability, given the leverage on the business, to gear up their EBITDA by at least 2 or 3 times, which simplistically means they can afford to do transactions up to 2 to 3 billion rand in size and still be very comfortably within their banking covenants and afford to repay the underlying payments to the banks. So given the current market value of Invicta is around 3 billion rand, they could do, as I termed on my social media page this week, a transformative deal to really kickstart this company. And that's exactly what Stephen Joffe, the CEO, was talking about on Monday and Tuesday in the results presentation, which was not that well attended by the market. And only a handful of people participated in the feedback session afterwards, of which I was one of them as a long-standing analyst in the company. So having covered the company for a long period of time, and as I said, seeing this dull as ditch water company go nowhere, I assume to myself the company's earnings growth in the early teens is not too shabby in a very low growth economic environment domestically. Its offshore businesses are growing quite nicely, thank you, with a rand hedge component now of around 50%. Its UK and Polish operations are growing at a reasonable speed. They've just opened up a distribution office in Louisiana in the States to move some of their product into a market which does not currently have a producer of these knockoff cheap parts into the second-hand market, and they expect to do reasonably well. They are increasing their pricing because of the fact that most of their products are manufactured in China and sold into the US, but the tariffs means they're putting up their prices, but they're still significantly cheaper than buying original parts. And in many cases, you cannot buy these second-hand OEM parts in the States because they're not produced. They have to be imported. So every producer is in exactly the same boat. So Invicta is not being prejudiced by being the only importer. Everyone's in the same bag. And if they do a deal, and I would not be surprised if in the next few months a sizable transaction were to be announced, that could be what I call the step change to kickstart this company. And to use a Star Wars analogy, I said a deal could be the touch point that can spark the flame that could lead to a resurgence and a renaissance in the Invicta share price. The net asset value is probably between 56 and 57 rand. The company in the last year has bought back 254 million rands worth of its own shares. Approximately 8.76% of all the shares have been bought back, just over 8 million shares. And they're still in the market buying back shares. They believe that they can see value in the stock at even higher levels than we see right now. So you've got a company which has got good earnings profile, a conservative balance sheet, effectively debt-free, looking to do what could be substantial transformative deals, growing its offshore rand hedge footprint, buying back shares with a very tight liquidity spread because management and Christo Visa own roughly 60%. So if we do see an institutional step change in this company, and institutions suddenly get interested, having not been interested in 2 or 3 years, there could be a nice little rally in the share price. For those that believe in technical analysis, and I'm not a huge believer, but I do keep an eye on it. If a stock breaks 35 rand, it could easily get to 40 to 42. So if you, again, put up a long-term chart of Invicta, if it breaks 35, it could be on for a run. Is that enough to rush out and buy the company? No, it's not. But when you have a number of touch points, both fundamentally and technically, which are stacking up to potentially move what has been an out of favor stock, only trading an a P of around 5.5 to 6, whereas nearest competitive comparison, Hudeco, is on a 10. It shows you that perhaps some value fund managers out there and some hedge funds are seeing what I'm seeing and could potentially buy the stock for a re-rating. So I would happily right now take some of the Clark Pension Fund money and buy some Invicta, which is trading today at around 33 Rand 50. Sit back, watch the action, and if it breaks 35 Rand, I think we could be off to the horses. So there's no immediate rush to go out and buy it, but given it's knocking on the door of a level which I think where it wants to run, where the underlying fundamentals of the stock have improved to a point where I have not seen in many, many years. It's certainly one what I think could interest particularly private clients because it's a mid-cap stock. It's a reasonably quality stock. The balance sheet's in good straits. It's got the backing of a very well-known entrepreneur, Christo Visa, and management under Stephen Joffe has fundamentally transformed this business over the last 5 years to be a much stronger, much leaner, much more efficient business. So Invicta to me right now, on the 3rd of July, looks like a very, very interesting prospect. It is now 7:15, and I'm going to be going through some of the Q&A because I think that is far more interesting than me rattling off some stuff. So the first question here is from Neo. Neo, he says, do I hear you correctly? You said Renogen is delisting. What is the reason behind this, may I ask? Again, a quick history lesson. Renogen, as we all know, has been under the whip. The share price literally was at 4 or 5 Rand a matter of months ago and was probably in danger of running out of money by August, September, and possibly even going into business rescue. The market has been aware there's been a number of approaches for the stock, but none had really transpired. And then a couple of months ago, in round parlance, a Nasdaq-based company called ASP Isotopes, and again, put up that share price chart on your screen, made an offer to buy Renogen, where you basically get ASP shares in exchange for Renogen. So the ratio from memory is 0.090916 ASP for every one Renogen, which given the current price of ASP, which is the equivalent of is trading at $6.89 in the States, and Renogen closed at their 10 Rand 97. The offer is roughly where the Renogen share price is right now. Now, ASP has been as high recently as $9.60. So it's come back from $9.60 to, as I said, to $6.89. The deal is currently under vote. I think there's a meeting happening in a few weeks. There was one last week to approve a transaction, which was resoundingly approved, because if Renogen shareholders do not approve this transaction and the deal falls away, it is highly unlikely that Renogen, in my personal view, will actually survive until the end of the year. So this is basically a rescue attempt. ASP Isotopes had a site visit for domestic and international shareholders about 2 weeks ago in Johannesburg. It was a 4-day event, 3 days of ASP, looking at its operations in and around Pretoria, and then 1 day going down to see Renogen's operations in the Free State. I participated in that 4-day site visit at my own expense, in case anybody out there thinks that I was paid to do this. It was certainly not the case. I've got the 11,000 Rand cost of the airfare and hotels in my file to justify this to the tax man when I do my tax returns. But as a Renogen shareholder, and perhaps somebody who may cover ASP, although I don't think I will because it's a Nasdaq listed company, although they are doing a secondary listing of a JSE, given a transaction to buy Renogen, it piqued my interest. So without getting into the complexities of ASP, because I'd be here for hours, because it is an extremely interesting and technologically inspiring business involved in extremely rare forms of metals and derivatives of the periodic table, for those that remember their periodic table from school and their physics lessons that perhaps you've never heard of. Silicon-28 and molybdenum and all sorts of strange and rare compounds, which perhaps many years ago had no fundamental use. But in the fast-moving age of technology, particularly with the advent of artificial intelligence, improved medical science, quantum computing, and ever faster demands on semiconductors, the compounds that the likes of an ASP isotopes currently produce are in extremely high demand. I'll give you one example, helium-3, which is an extremely rare isotope derived from the helium gas, is currently selling for $140 million a kilogram. I'm not saying that Renogen is going to be producing that much. They'll probably produce a tiny fraction of that, but showing you the pricing of some of these rare compounds. Silicon-28, which is used in the latest generation of the Nvidia super fast chips, sells for $500,000 a kilogram. And ASP intends to produce over 50 kilograms a year and escalating. They also have an isotope developed from nuclear medicine. So basically, they've taken a highly radioactive element from a periodic table. They've extracted one tiny part of that molecule in an isotope. And in conjunction with the global Swiss pharmaceutical giant Novartis, have developed a revolutionary treatment that can help remediate and even cure prostate cancer, which is one of the biggest killers of men internationally. And this tiny little isotope, which looks like a grain of rice, is injected directly into the cancerous cells and can remediate prostate cancer for a number of years. And that is currently under test and has very, very positive feedbacks. I'm using the wrong word here, but I'm not a medical person, but the feedback from Novartis is extremely encouraging, and they're taking this product internationally. So that's the type of thing that ASP does. How does Renogen fit in? Well, they see that helium is a rare gas, again used in the semiconductor industry, and ASP wants to have a basket of rare earths and rare elements to offer to its international client base. And that's the reason why they believe that Renogen fits into the ASP isotopes basket. So that's the reason why I was on the site visit. ASP is an interesting, if complex, business. There is a research document from Canaccord, which I think I published on my social media page a good month ago at Small Talk Daily, which you can have a look at. I'm happy to provide the link again in the next day or so, and it'll explain much better what ASP isotopes is than I ever can in the limited time I have on this Rand Swiss webinar. So that explains why Renogen is delisting and being bought out by ASP. Zeta from Abel. Any prospects of winding up soon? From your lips to God ears. The only asset left inside Zeta is a bit of cash and a stake in Zod, the agricultural diversified company which is involved in chemicals and seeds, etc., etc. I am well aware there's been a number of offers for parts of Zod, but I think it'll be sold piecemeal. Because Zod is stuffed full of debt, and the pricing and the results have been lackluster for quite a number of years, it would be very difficult for anyone to come in right now and pay a reasonable price for Zod. I think it's going to be a piecemeal breakup. And as I've written for the last 2.5 years with Zeta, it's basically dead money. If you'd left your money inside Zeta, yes, you would have got special dividends. But the share price has basically unwound as you're sitting there waiting for the next asset to be sold to get your special dividends. So If I want to be in dead money, I just leave my money in the bank. So to me, Zeta is basically a horse waiting to be taken to the glue factory and shot. I have no interest in owning that company, and I do not see any transaction happening anytime soon. Okay, I've talked Chaz about Renogen and that offer. Uh, Gavin Woods, you have been positive and Argent and the results. Do you believe it still has upside potential? The answer is yes. I'm working on an Argent note right now. Uh, there's my file. I spoke to Treve Henry last week, the CEO. We speak fairly often. Earnings came out this past week or so, slightly above my own expectations. The share price is trading at around 26 Rand 50 round numbers on a P of around 5. The net asset value is trading in the mid 30s. They've got nearly 500 million Rand cash in the bank, which is approximately about 30% of the company's market value. They are 75% Rand hedge, with operations principally in the UK, parts of Europe, and the US, mainly involved in highly specialized areas to do with the transportation of fuel at airports and around Europe, which is heavily regulated due to health and safety. And if anybody knows anything about Europe, is that health and safety regulation never goes backwards. It always gets worse and worse and worse and worse. So if you're involved in a regulated industry, you should do quite well. And Argent is. I'm an Argent shareholder. I had my first buy in that stock in March 2019 at 3 Rand 52, and a second buy in May 2019 at 4 Rand 84. Every single price target I have set on Argent has been exceeded and broken. Initially 8.50, 11.50, 14 Rand, 16 Rand, 18 Rand, 22 Rand, 28 Rand, and my current target is 32. So on a price earnings ratio of 5, with the company announcing its results, it's continuing to buy back its own shares. It's bought back nearly 30 million shares in the last few years, with net cash in the bank, and it continues to look for bolt-on strategic acquisitions, principally offshore, to bolster its Rand hedge component. To me, Argent is one of those stocks that any growth portfolio in the small cap space should have. Now, the share price has had a hell of a run. The Daily Maverick today issued a story that the share price has gone up 400% in the last, I think, 4 or 5 years. And as I commented, well, it's quite nice that the Johnny come latelys are coming to the party at about 26 to 27 Rand, when you could have bought their share only a matter of years ago at between 4 and 6 Rand a share. But back then, nobody gave a damn apart from me. So to me, Argent, despite its heady run, continues to be a value proposition because it's on a P of 5. And I think Pitt Villiers at Merchant West had a number of comments today on varying social media platforms, and they are very large holders, again extolling the virtues as an institutional investor of the company. So from my perspective as a shareholder and an analyst for over 20 years, I have no reason not to continue my positive assessment and recommendation of Argent, and my current target price is 32 Rand. Let me scroll down and see what other questions we have. From Robert, hi Anthony, you previously mentioned Sea Harvest a while back. Do you have a feel as to what sustainable EPS will end up being, and how will you determine a fair price for the share? Well, thank you. If you read this week's issue of the Financial Mail, and if you turn to page 46, there we are, 46, I wrote a piece on Sea Harvest in the Financial Mail, and I also posted that article on my social media page at Small Talk Daily, I think earlier this week. I justifiably stated in that article that I've been fundamentally wrong on Sea Harvest for the last 3 years. Every time that the market, and I believe that the corner was about to be turned after a period of awful results, the results just got worse and worse and worse. However, Anything involved with Mother Nature, be it agriculture on the land or fisheries in the sea, the cycles and the seasons always turn. And that is true for Sea Harvest and Oceania year to date, where the fishing season has been significantly better than it has been for the last 4 years. And in fact, it was the last time that fishing was this bad was 2006, and that lasted 3 or 4 years. Here we are now in 2025, and after 3 or 4 years of awful wild catch fishing, we now have a much, much better period ahead. You've seen two trading updates from Sea Harvest. The latest, which came out, I think, about a week ago, indicated that the headline earnings per share for the 6 months to June would be up over 60%. From memory, the high of earnings of this company was about £1.58. And since then, they've just consistently plunged and plunged and plunged. I would hope that if Sea Harvest were to get back to an earnings range of around £1 to £1.20, which I think is possible on a rolling 12 months basis, when the stock was trading at about £6 a few weeks ago, it was looking incredibly well priced. When I wrote my article, it was trading at around £8 to £8.50, trading at a P of around 7. So I thought that was a fair price. Now, there are a number of touch points which have to work in Sea Harvest's favour to get a further re-rating. I had a valuation of around £10.50 from memory. They've got a huge debt pile of around 2.8 billion rand. And I've been on public record saying we have to sell some assets to repay that debt. And I think they've now reached a point where something will be sold in the next 2 months to bring that debt down, to refocus the company possibly back on a pure fishing business. They currently have a dairy operation making butter and cheese and powder and milk powder. And then they have an operation in Australia involved with prawns and wholesaling. But the bulk of their business is involved either in wild catch hake and an abalone business. Now, the Australian business, the abalone business have had, quite frankly, an awful few years. Wild catch has also been very problematic because of the catch rates. And the dairy side has had good years and bad years. So as it stands right now, the article, which I think is succinct and doesn't pull any punches, says sell something, repay debt, focus a business, stop buying stuff, consolidate what you have, improve your margin, and stop empire building. If you do all of that, I think the share price will start to move. So as it stands right now at around £8, I have a buy in the stock, and I think £10.50 is a fair price with earnings of between £1 and £1.20 on a rolling 12 months basis. If I can squeeze one more question in, or I've answered that question, and I've answered that question, and I've answered that question in Invicta, and I've answered that question, and I've answered that question. I will talk about capital appreciation, but I'm going to run out of time. I had lunch with Bradley Sachs last week. It's an interesting company, and it's one that I'm thinking of covering, but I don't currently have enough information on the company to formulate a view. There's lots of questions. I've mentioned those, I've mentioned those, I've mentioned those. So thankfully, many of the questions that you're asking on Argent and Renogen and Invicta and PPC and Grindrod, I have answered in this webinar. One last question, again, from Gavin Bowes. Will the Advotech share price bounce like Stadio has? Again, I'm going to say to you, read this week's Financial Mail. On page 41, you'll see pick of the month on Advotech. I wrote that pick of the month, and it tells you exactly what you need to know on Advotech as to why I think at these current levels, the share price will recover. It certainly will not bounce as hard as Stadio, which is running for other reasons. But to me, Advotech has been left behind. And relative to Stadio, it has got a period of catch-up, and I can see at least 15 to 20% catch-up in due course coming from Advotech. Now, I've gone over my time, and I'm sure Pascal is tapping her fingers on the desk, wanting to go home and get some supper. And from myself, Anthony Clark at Small Talk Daily Research, I'd like to thank you all for participating in this Rand Swiss sponsored quarterly webinar. The next one will be in 3 months' time. And I think perhaps in that next one, if Pascal is happy, I will not run too much over my top stocks. What I'll do is I'll just have an extended Q&A session. Now, I cover about 60 stocks, and perhaps nearer the time, I will put up on my at Small Talk Daily Research Twitter page, or X as it's now called, a list of all the stocks that I cover. And if anybody has some specific questions on those, I'll be happy to engage in a Q&A and perhaps an extended Q&A, because I understand, given the number of Q&As I've had on this platform this evening, I had 23 separate questions. Clearly, it's an area that is of interest to the listeners. So from me, Anthony Clark, and my sleeping dog behind me, I'm going to wish you a very happy evening from a chilly, wet, and miserable Cape Town. Have a wonderful long weekend. And don't forget, the US market is closed tomorrow for Independence Day. And on that note, good evening and have a very, very happy weekend. Take care.